Number one, I've been generally long here over the last 1 week period, expecting a relief rally to take us at least into the midterms. And I use the midterms in a weird way, just like all election cycles. Is if early in the year oil was at 130, I'm like, it's not staying at 130 going into the midterms. They're going to do whatever they have to do to bring it down. And we saw the strategic oil reserve release as well as other things. But politically, they got to do that. It's only a small point area of it. But I also think that if you looked at the dollar, if you looked at the dollar yen, I mean, there was major stress, and we saw it even develop in the UK with what the Bank of England had to do. Major stress on the global financial system. And for me, as soon as I see that, when I see the dollar yen and the chart go vertical like that, something is going to break, or the central banks have to work together to do it. And what's amazing about today, right? Think about this. You basically had a 1-2 punch where the Wall Street Journal came out and said, hey, the Federal Reserve is going to likely raise by 75 basis points in the next meeting, and then they're going to pivot. All right. So that was the first punch that was given, and the market began to rally back. The second one was that the Bank of Japan then intervened, and we saw this massive decline on an intraday basis on the US dollar yen, the dollar yen. And in fact, let me try to bring it up. It's like, whoa, you don't see currencies move like this, but look at that collapse on the dollar yen on an intraday basis. That's the 10-minute chart. And what that told me is that, and this is what's amazing, is that there was coordination. And I think that's something we have to take. And I think that's something that the market should be bullish on, is that you obviously had this. So the Wall Street Journal, you could say, okay, well, Wall Street Journal, they're just a news source. But in the past, the Fed has used them to convey ideas on what they're going to do on rates. So we have to take that as something serious. And then to see the Bank of England act an hour later, it was definitely a coordinated effort to try to weaken the dollar, strengthen the yen, probably because the Bank of Japan was saying, hey, guys, if this continues, we're going to have major cracks in our system, and I think globally. So that was a really interesting thing, and that basically puts me in line with thinking that we rally up generally into the midterm elections. Afterwards, I'm still in the downside camp. I think we're going to start to see some really negative economic news hit, and I do still think there's further downside. A little bit, but not enough to sway me from macro and charts, right? So macro and charts are the forefront. And then if the macro and charts align with the seasonality, then heck yeah, that's like an added bonus. This year, I'm not so sure about the seasonality because, again, we have to see how the markets react post the elections, and then where do they end up heading? But I still have us priced in by year end to go down on the S&P 500 to that pre-COVID high. In fact, let me show that chart again, because I think it's an important chart to take a look at. But basically, we should head down to, I think it's around 3,300 on the S&P. It would be right here on the spiders, this 337, 338 level. We got close. We didn't get there. If I just had to do some simple charting on where I think this bounce is going to go, take the COVID low to this pivot, and I think that's where we're headed in the next week or two going into the midterms on the spiders. So you're talking like 385, 386, another $13 or about 130 points on the S&P 500. But once we get there, I think you have to start looking for further downside again. So I am heavily long gold. It's actually my biggest position right now. So I am bullish on gold. And I think the key on me getting more and more bullish and adding to my position is the fact that we're getting closer to this pivot, right? So we've seen the dollar get ridiculously strong to the point where, to me, it's looking like it's due for a reversal. And then we have the potential of this pivot coming in with the Fed, which, again, remember, a pivot, it doesn't mean they're going to start lowering interest rates. It's just where they're not going to raise it anymore. But just that alone should weaken the dollar, which will then help gold. And I think as the economy slips worse into a recession, number one, and then into a worse recession, money is going to start to look for places to go, right? So you're going to say, okay, well, as we get into a recession, all these earnings estimates have to come down. And the worse it gets, they're going to come down more and more. So stocks probably do continue lower, even in the face of a Fed pivot. But then the question is, well, where do you put your money? Well, you have Bitcoin, but that's still risky. And then gold is going to probably be that main recipient. So I think the low on gold should coincide right around here with a Fed pivot. And then as the Fed gets more lenient over time, as the economy spins into a worse recession, gold should do better and better. Yeah, I do. I really do. And I think that's going to coincide with the pivot of the Federal Reserve. And one thing I'd love to show here, this is just a cool history lesson, is to go back in the 1970s when the last time we had this high inflation going on. And so you think about inflation, and really it started around in the 70s, it was around 75 into the early 80s. And what we saw is leading into 75, in that early portion, the markets were anticipating inflation. And so we saw gold rally up here beautifully. And then once we got that inflation, gold actually started to pull back and kind of flag. This is what we would refer to as like a bull flag. And then later in the 70s, around 77 or so, the next big move in gold has started, and that was the mega move to the upside. And so if you look at this, right, we basically have, let me just draw some trend lines here. This is what I would refer to as, in the near term, 2018 to 2020. And in here, it was 72 to 74. So about 2 years of upside. Then you had about 2 years of consolidation, and then the big blast higher like this. Well, if we go back, let's speed forward, and let's look at the chart here. And basically what you have is that same sort of thing where you had from 2000 right here. Well, this is even a little bit further, but let's just talk about this shorter term. You have the 2-year move up from 2018 up here. Then you have the 2 years of consolidation. And then I'm guessing we have that big breakout coming over the next few years, where I think gold, honestly, easily to $3,000, $4,000, $5,000 an ounce. So it's actually my favorite multi-year play, mirroring the 1970s, as the 1970s into the 80s is the closest parallel we have in terms of extended inflation. I think that's exactly what's happening here. And again, it makes a lot of sense if you think on the macro basis of the steps that are going to be taken. So you've had this rising rate environment, which has strengthened the dollar. So that's what's been putting pressure. But remember, the dollar rallied 20%, and gold, what was gold down this year on a 20% rally in the dollar? Like 7%. So to me, I look at that and I'm like, wait a minute, shouldn't gold have been down 20% if the dollar was up 20? And it wasn't. So that's got to tell you something, right? That's got to tell you there's obviously a positive divergence, or at least some big money accumulating on gold. And I'm a big fan of like these underlying big money accumulations, the ones that aren't being talked about. You don't have big funds saying, hey, everyone accumulate gold, because then it wouldn't be the gold accumulation. It's when they do it in silence that you have to pay attention. Yeah. Silver, again, it's a little of a trickier one because of the industrial side, right? So everyone, keep in mind, silver has two sides to it versus gold really has one side. Gold protects you. It's where people go for safety. It's an inflation hedge. But silver is an inflation hedge, but it's also an industrial metal used, like you said, solar panels, EVs, etc. So if we saw a big slowdown in the global macro economy, then you could look at saying, okay, well, how does silver perform, being also a store of safety? And so that's where it gets a little trickier. Having said that, silver is into a huge amount of support here. It's really come in substantially. And if you look at gold, right, what percentage drop has gold seen? Again, for this year, 7% or whatever it is. On silver, it's way more. I mean, it's about 33% drop from the highs here. Well, this is from 2020 highs, but still, that's a big drop comparatively to gold. But look at the levels you're now hitting here. You're hitting all these support lines down here going back to 2017, and you could even extend it back to 2014, and even right here. I mean, look at this. So if there's ever a technical level on silver, this is it. And so I'm actually long silver, not as heavily as gold, but I am long some silver here. Silver is like, let's not forget that on silver, if you go back, I believe it was in 2008, the bottom was in around $8.75, and we had this mega bull run to $50 an ounce. Yeah. And so you could argue that from the collapse of 0809, you saw this kind of rush into that metal. And if we are going to go into something more dramatic than just a minor recession, that maybe ultimately silver is on the verge a couple years away from a mega spike again. So I think it's worth having some investments in there. If they continue to raise rates, there's no way the markets can fight that. And again, keep in mind that a lot of people don't quite understand the parallel between bonds and the stock market. But as yields rise, as interest rates rise, what it does is it coaxes some money out into bonds, because people say, hey, for risk-free, I can get, now on the 10-year, you can get 4.2, 4.3%, whatever it is right now. And so the higher it goes, it pulls money away from risk assets, which, as we say, it's a risk asset. You can lose money investing, or you can make money. So So I think, again, the higher rates go, you have to reduce the price on stocks or the levels on stocks. But the question is, we know the market is forward thinking, right? So as soon as the market smells that pivot where they're going to stop hiking, that's where that rally starts. So I think that's what we're watching for now is like, is this some real stuff that we can sink our teeth in from the Wall Street Journal commentary today about the Fed pivoting after the November hike. And I think the biggest thing is now looking at economic activity, right? So we have to start looking at all these economic numbers even more closely to see, does it give the Fed that reason to pivot at this point to at least stop hiking rates? And I do think, I've been shocked at how strong the jobs numbers have stayed, considering that, every day I'm hearing about, like, Intel now is going to lay off 10% of their workforce, I heard, over the next few months. There's so many companies laying off, but it hasn't filtered in. I do eventually think it does, and we see a pretty steep drop off in the economic activity.